I talk about two types of income on Monday, taxable income and account income. Before this, you guys have to understand I for income. Okay, income is a difference between revenue and expense. Okay, income is revenue minus expense. And two types of income, taxable and accounting. So taxable income is tax revenue minus tax expense, TR minus TE. And accounting income is AR, accounting revenue, minus AE, accounting expense. Okay? And when we determine accounting income before tax income, income from continuing operation before tax, okay? Those are, simply speaking, accounting income, okay? And this is income before tax. Income before income tax is deducted, okay? And this accounting income is reported on income statement, accounting income statement, and accounting revenue and accounting expenses are measured by accrual accounting principle. Revenues are measured and reported when earned, and expenses, accounting expenses are measured and reported on the accounting income statement whenever incurred, right? Earned and incurred. Two magic words for accrual accounting principle. But on tax return, okay, taxable income is reported on tax returns, okay, and tax revenue is reported on tax return when cash is collected, and tax expenses are reported on tax returns when cash is paid. Okay, so cash basis for taxable income, and accrual basis for accounting income. And because of two different rules, okay, the taxable income and accounting income are almost always different. Okay, those two are different. Before we get into details in chapter 18, you have to understand this one first. Income is the difference between revenue and expense. And also, in chapter 18, we are going to compare taxable income with accounting income. Okay? Taxable income should be compared to accounting income to determine either DTL like this, or DTA. Okay? Taxable income should be compared to accounting income, because we are going to look at accounting side of income tax liability and income tax asset. Okay? So these two incomes are compared to each other. So think about this. If tax revenue is, okay, tax revenue, TR, tax revenue is greater than accounting revenue. Okay? If tax revenue is greater for some reason than accounting revenue, then taxable income should be greater or less than accounting income?
Less.
Taxable income should be higher, right? Taxable income should be higher than accounting income. Why? Because the revenue and income, okay, revenue and income move in the same direction. If revenue is high, income should be high, right? Whenever you have a high revenue, high sales revenue, your income should be high. Revenue and revenue and income move together, always in the same direction. If tax revenue is less than accounting revenue, then TI should be also less than AI, right? Revenue and income always move together in the same direction. What if tax expense, okay, tax expense, like tax depreciation. If tax expense is greater than accounting expense, okay? For example, if tax depreciation expense is greater than accounting depreciation expense, taxable income would be taxable income less than accounting income. Yeah. Expense and income. There's a negative sign, right? Negative relation between expense and income. If expense is high, income should be low, and vice versa, right? Negative or inverse relation between expense and income. So, if tax expense is higher than accounting expense, if tax depreciation is higher than accounting depreciation, then taxable income should be smaller than accounting income. And if tax expense is less than accounting income, then taxable income should be higher than accounting income.
Don't you mean accounting expense?
Yeah, accounting, sorry. Okay? So there are 4 cases. Okay, 4 cases. And we will talk about these 4 cases for DTL like this and DTA. Okay. DTL, deferred tax liability, and DTA come from these 4 cases. Okay. So we always have to compare these 2 incomes. Taxable income is compared to accounting income to determine DTL or DTA. Okay. All right. So we talked about this on Monday. 4 depreciation method for accounting. Okay. We can choose any of 4 depreciation method. And in this example, we choose to use straight line. Okay. On the straight line, annual accounting. Okay. Straight line is only for accounting. Straight line is never used in tax. Okay. Straight line is only for accounting. So accounting depreciation is $400 per year. Okay. Remember, straight line depreciation is only for accounting. Okay. Never used in tax. For tax depreciation, we have to use so-called MACRS, Modified Accelerated Cost Recovery System, if an asset is purchased after 1987. So 2 different depreciation schedule. This is for accounting and this is for tax. Okay? And difference between accounting and tax depreciation is temporary like this. In the long run, over the life of the useful life, there's no difference between total depreciation. Same at $2,000. In the long run, 0 difference. Okay, so this is a perfect example for temporary difference. Okay, temporary difference in depreciation. Okay, the difference between accounting and tax depreciation is temporary, but in the long run, 0 difference. And for this example, we assume that revenue is same revenue. So TR and AR. These 2 revenues are same as $1,000. Okay, $1,000 per year. And depreciation is only expense, and tax rate is 40%. Okay. All right. In the first year, accounting depreciation is same as tax, at 400, 400, and 400. So there's a zero difference in the first year. Okay, and so there's no temporary difference, zero temporary difference, and account income is same as taxable income. So okay, tax depreciation 400, accounting depreciation is also 400, 400, 400. So taxable income and account income is $600 right? In the first year. 600 account income, 600 taxable income. Because of same revenue, same expense. Only in the first year. Okay. So the taxable income is 600, and your tax liability. When you file your personal tax return on Form 1040, your tax liability is based on your personal taxable income, right? Your taxable income determines your tax liability. Same thing for corporation. These companies' taxable income in the first year is $600. Okay, so the amount of income tax liability for the first year is 240. Okay, taxable income 600 times 40%, tax rate is 240. Okay, taxable income times current tax rate is recorded in account name of income tax payable. Income tax payable. This 240 should be paid to government in about 3 months in practice. So the income tax payable is always based on taxable income. Okay, income tax payable has nothing to do with account income. Okay, income tax payable should be based on taxable income. Taxable income determines tax payment, tax liability. So the 240 income tax payable is always based on taxable income. Okay, so the amount of income tax payable is always like this: taxable income times current tax rate. Always like this. Okay, so let me write them over here. Income tax payable, taxable income, not account income, taxable income times current tax rate. Always like this, income tax payable. And in practice, this 240 income tax payable should be paid to IRS in about 3 months. So this is always classified as current liability. Okay? Always reported as current liability. Okay? So in this simple example, you have to remember this one. Income tax payable, okay, as a current liability is always taxable income times current tax rate. Sometimes future tax rates are different from current tax rate. Okay? In that case, we have to use current tax rate for income tax payable and future rate for DTL or DTA. Okay? We have to use future tax rate for DTL and DTA. But for income tax payable, okay, we always have to use current tax rate. Okay? So there are only a couple of things in chapter 18. Only 2 things you have to remember and understand for chapter 18. Number 1 is this, and number 2 is DTL, deferred tax liability, okay, DTL, or DTA as an asset. This is temporary difference like this. Okay, we'll talk about this temporary difference in a few minutes. Temporary difference times temporary difference in depreciation, temporary difference in prepaid expense, temporary difference in warranty cost. Okay, there are a bunch of temporary differences in income tax accounting. So temporary difference times future tax rate is either DTL or DTA. Okay? So these two are the most important thing in Chapter 18. Okay? Income tax payable as a current liability, always taxable income times current tax rate. DTL or DTA, okay, should be based on future tax rate. Future tax rate times TD, temporary difference. Okay. All right. Let's get to the temporary difference. So in the first year, okay, journal entry is no big deal. Just simple. Okay. Once you determine income tax payable, debit income tax expense, credit income tax payable. And the first year, 2001 income statement, this is income statement. Not tax return, but income statement, okay? Accounting income statement. This is accounting income statement. Income statement is only for accounting, not tax, okay? This income statement is never reported on tax return. Income statement is only for accounting. So on this accounting income statement, we report 1,000 sales revenue, okay? And depreciation, 400 accounting depreciation. So before tax income or income before tax is 600. So as I mentioned on Monday, AI, this AI is income before tax or before tax income. Okay? Income before income tax expense is deducted. Okay? Income before income tax expense is deducted. So if you deduct 240 income tax expense, then you'll come up with 360 net income. Okay, net. Net income means net of income tax expense. Okay? Net of income tax expense. Okay? So don't get confused between net income and accounting income. Net income means net of income tax expense. Okay? Income tax expense is deducted. But accounting income is before tax income. Income before income tax expense is deducted. Net income is income after, okay, income after income tax expense is deducted. Okay? Before income tax, after income tax. Okay? So the first year transaction is no big deal. Okay, very simple because these two incomes are same. Okay, now second year. I think this is the most important part in Chapter 18. Second year. Okay? The depreciation schedule for second year, look at the second year schedule. Okay, this is from this schedule, 2002. We are in 2002, second year. Okay? Second year, tax depreciation is 640, 32% is depreciated. But accounting depreciation is still 400. Always 400 on the straight line. Okay, so temporary difference 240. Okay, is temporary difference is 240. Temporary difference in depreciation in the second year is 240. Okay, and from number one over here. Okay, income tax payable first. This is more important than anything else, because this amount should be paid in cash to government, okay, in about 3 months. So you better determine the amount of income tax payable first. Income tax payable. Second year taxable income is, okay, second year taxable income, tax revenue 1,000, tax depreciation, second year 640, right? So taxable and tax revenue 1,000. Same as accounting revenue, we assume always $1,000. Okay, revenue always 1,000. We assume so. So second year tax revenue is 1,000, and second year tax depreciation is 640 from the schedule. So second year, 2002, taxable income is 360. Okay, taxable income for 2002 is 360. That 360 taxable income times 40% tax rate is income tax payable. We assume tax rate is always 40%. Okay, all the way 40%. So the amount of income tax payable is 360 taxable income times 40% tax rate is 144. Okay, so in second year, this company must pay 144 to government in about 3 months. So income tax payable as a current liability on credit like this. Income tax payable on credit 144. Okay, one down. And then next thing we have to figure out is either DTL or DTA. Okay, so determine income tax payable first. One down, one more to go. Income tax payable always as a current liability, so should be on credit. Liability on credit, right? And then we have to take a close look at 240 temporary difference. Okay, temporary difference. If these two incomes are same, then we don't need to worry about DTL or DTA. Okay, but in the second year, these two are different because of different expense, right? Because of different depreciation, these two incomes are different in the second year. Okay? Now, look at this paragraph. Why did I highlight this part? Because this is muy importante. Okay. This is very important for chapter 18. In the second year, if taxable income is same as accounting income at 600, accounting income is always 600. Accounting income, his income is always 600 because accounting revenue is 1,000, accounting expense is 400. Always 1,000, always 400 by assumption, right? So accounting income is always $600 from 2001 through 2006. Always 600. Okay? So in the second year, if taxable income is same as accounting income at 600, then this company would pay 240. 600 times 40%. If tax, by the way, this is just way of thinking. Not actual, but just way of thinking. You better think this question in this way. In the second year, if taxable income is same as accounting income at 600, this company would have to pay $240 income tax to government. But because of small taxable income, okay, small taxable income compared to accounting income, this company pay only 144. Okay? Let me do it again. In the second year, if taxable income is same as accounting income at 240, I'm sorry. If taxable income in the second year is same as accounting income at 600, okay, this company would have to pay 240. But because of smaller taxable income, this company pay only 144. Okay, and payments are deferred to future period. And the deferred payment is difference between 240 and 144. Okay, so payment for 96 is deferred to future period, 2003, 2004, or 2005. Okay, so again, in the second year, If second year taxable income is same as account income at 600, this company would have to pay $240 income tax. But because of small taxable income compared to 600 account income, this company pay only 144. And the payment for 96 is deferred. And that 96 is difference between 240 and 144. Okay. So 240 is an income tax based on account income, and 144 is income tax based on taxable income. Okay. So payment for 96 is deferred. And this $96 is also, as I mentioned over here, 40% of 240. 40% of 240. 40% is a future tax rate, which is same as current tax rate. And the 240 is this 240. Okay, 240 is temporary difference. So DTL is always like this. Temporary difference, 240 in the second year times future rate 40%. And in this example, we assume future rate is same as current tax rate at 40%. Okay. So tax rate is always 40%, as I mentioned over here. We assume so. Okay. So if future rate is not 40%, then we have to use that future rate for DTL or DTA. Okay. So again, this is just way of thinking. In the second year, okay, account income is 600, taxable income is 360. Account income 600, taxable income 360. Account income is higher than taxable income, or taxable income is less than account income. So like this. Because of large tax depreciation in second year is 640. This is 640, and accounting depreciation is 400 in the second year, right? 640 tax depreciation and 400 accounting depreciation. So in the second year, year 2, tax depreciation is greater than accounting depreciation by 240, right? 240. So second year, temporary difference is 240. And because of this, okay, because of higher tax expense, second year taxable income is smaller, okay, less than accounting income. And whenever you have a small taxable income, you will pay small income tax, right? Your tax payment is always based on taxable income. So less tax is paid now, and more tax will have to be paid in the future. Okay? So look at this part. Tax expense, tax depreciation is greater than accounting depreciation in the second year. And because of this, second year taxable income is small compared to accounting income. Okay? And because of small taxable income, less tax paid now, less tax, only 144. And more tax will have to be paid in the future. Payment for 96 is deferred to future period. So in the second year, this company has an economic obligation to pay more tax in the future. Obligation to pay more. And that obligation is recorded in this liability account. Account name is DTL. Okay? So we have income tax payable 144, and this amount should be paid to government in about 3 months. So always current liability. Then what about $96? DTL. This is another liability. Okay? And there's a rule for accounting rule for classification of DTL and DTA. And the rule is very simple. Classification rule is simple. As I mentioned down here, DTL is classified as either current or long-term, depending on classification of related asset or liability. Okay? So in this example, this 96 DTL come from depreciation on personal computer. And the personal computer is a long-term asset, right? So all 96 DTL should be reported as a long-term liability. Okay, this is a long-term because personal computer is a long-term asset. Okay, rule is very simple. Okay, and then debit entry, debit, income tax expense, and look at this, plug. You guys know what the plug number means. Plug. So never try to compute this plug number. This is determined after this two. Automatically determined after this two. Okay? The amount of income tax expense is always plug number. Okay. So we have to determine income tax payable first, okay, because this amount should be paid in cash. And then DTL or DTA. And income tax expense is always plug number. Okay? So never try to compute income tax expense first. Questions? So in the second year, income statement. Again, income statement is for accounting only. We have same 1,000 accounting sales revenue, 1,000. And accounting depreciation is 400, right? But income tax expense is 240. And this 240 consists of two parts, current 144 and 96 deferred. So before tax income or income before tax or accounting income minus 240 income tax expense is net income of 360. Okay? Income before tax, income after tax. Before and after. Okay? So remember, income income statement is always for accounting. Okay? This has nothing to do with tax. This is always for accounting. Okay, so second year journal entry, debit income tax expense, credit income tax payable, and DTL. Okay, and as you can see on this table, 240, temporary difference. The temporary difference originated in 2002. Okay, originated in 2002, and then this temporary difference start to reverse in the third year. Look at the third year depreciation. Accounting still 400, but tax 384. So now in the third year, okay, tax depreciation is less than accounting. Okay, so this temporary difference start to reverse in the third year. What does that mean? In the third year, there must be decrease in DTL. Okay, increase in DTL in the second year like this. Okay, increase in DTL in the second year, but there must be decrease in DTL in the third year. Okay, so according to this formula, this is not a formula, but whatever you call it, the temporary difference, okay, TD, this is not touchdown, but temporary difference, either increase or decrease, it doesn't matter, okay? Increase or decrease in temporary difference times future rate is DTL or DTA. So in the third year, we have accounting income still 600, okay, always 600 like this. Taxable income, 1,000 tax revenue, okay, 1,000 tax revenue, and 384 tax depreciation, okay, 1,000 tax revenue minus 384 tax depreciation expense is 616 taxable income. Okay, third year taxable income is 616. And from number 1 over there, okay, income tax payable is always taxable income 616 times 40% tax rate. Okay, so income tax payable is 246. Okay, income tax payable is always current liability. So that 246 on credit like this. Okay, 246 income tax payable on credit. Okay, and now decreasing liability. We have to record decreasing DTL in the third year. Okay, the temporary difference in the third year is negative 16. Okay, so negative 16 times 40% tax rate is 6.4. Okay, 6.4. 16 temporary difference times 40% is 6.4. Increasing liability on credit, but decreasing liability should be on debit, right? So 6.4, this one, 6.4, decreasing DTL on debit. And the amount of income tax equivalent, always plug number. So this 240 is difference between 246 and 6. Okay. Income tax expense is always plug number. So at the end of 2006, the balance of DTL should be how much? 0. That's right, 0, right? $96. Okay, initially $96 on credit in the second year, and then keep decreasing, right? The DTL will decrease every year, and then at the end of 2006, the balance should be 0. So, again, there are only two things you really have to understand and remember. Number 1, income tax payable. Number 2, DTL and DTA. So this income tax payable should be paid in cash to government in about 3 months. So that is always reported as a current liability. And that income tax payable is always based on taxable income. Okay? Taxable income determine income tax payment. Okay? All right, any question? So again, compare two incomes. Two incomes. Income tax, taxable income is compared to accounting. Okay. Now, DTA, deferred tax asset. Okay, DTA is an asset. So this is just opposite. Opposite. So DTL is recorded when taxable income is smaller than accounting income. Okay. Whenever taxable income is smaller than accounting income, a company has a situation where less tax is paid now because of small taxable income, and more tax will have to be paid in the future, right? And this situation comes from either this or TR, tax revenue is smaller than accounting revenue. Okay, if tax expense is greater than accounting expense, or tax revenue is smaller than accounting revenue, then taxable income would be smaller than accounting income, right? Now this is just common sense, isn't it? If tax expense is higher than accounting expense, or if tax revenue is smaller than accounting revenue, then taxable income would be smaller than accounting income. In this situation, we have to record TTL, liability. Why liability? You have to understand conceptually. If the situation is like this, a company pays less tax now because of small taxable income. And this means more tax will have to be paid in the future. More tax is coming, okay? Obligation to pay more in the future. That obligation is recorded in this liability account. Either this or this. TTL should be recorded, okay? Now, just opposite. So this is a liability. If tax expense is less than accounting expense, or if tax revenue is greater than accounting revenue, okay, either this or this, then TI, tax income, would be greater than AI, right? Yeah. Taxable income, if taxable income is greater than accounting income, then a company must pay more tax now, because of large taxable income. Okay. If taxable income is high, you have to pay more tax. You have to pay high tax, right? More tax now and less tax later. Less tax later. What does that mean? A company has an economic benefit or economic right to pay less tax in the future. And that economic benefit or right is recorded in this asset account. Asset. Right? So liability is an obligation. Obligation to do more. Obligation to do something in the future. And asset is an economic benefit. Economic benefit or economic right. So in this situation, a company has an economic benefit to pay less tax in the future. Okay? And that benefit is recorded in this asset account. Okay? This is directly from the current accounting standard, but then much important. Okay, there's a little small restriction on the recognition of DTA. Okay, but as I mentioned over here, there's no problem recording DTA as an asset. Okay, if it is more likely than not, a company will earn taxable income in the future. As long as a company is expected to have a taxable income in the future, a company has no problem reporting DTA as an asset. Okay, but this is not that much important. All right, let's take a look at this example. On December 31st, 2001, okay, at the end of 2001, a company received $1,000 for a 2-year rent. Okay, so this is a short-term lease. Okay, and this company is a building owner, landlord. Okay, so this landlord, lessor, collected $1,000 for 2-year rent. Okay, 1,000 payment was made in advance. Sales revenue was 1,000 and cost of goods sold 700 for accounting and tax. Okay, so sales revenue and cost of goods sold are same for accounting and tax, and the tax rate is 40%. Okay, and you have to pay attention to this 1,000 rent, 1,000 lease. Okay, on 12/31/2001, in the first year, okay, at the end of the first year, okay, landlord, lessor, received 1,000 cash. So the lessor, landlord journal entry, debit cash 1,000, okay, and what should be on credit? This 1,000 payment is for 2023, not 2001, but 2023, collected in advance. So what should be on credit? Huh?
Unearned revenue?
Unearned revenue, that's right, yeah. Earned revenue, $1,000, right? 1,000. And this is what you study in Accounting Principle 1. Okay. Typical journal entry for unearned revenue, right? Revenue is not earned. That is why the name is unearned, right? And then at the end of 2002 and 3, we have to prepare adjusting entry, right? Adjusting entry. This 1,000 recorded initially in unearned revenue account, and then at the end of 2002 and 3, okay, half and half, 500 decrease in unearned revenue, 500, and what should on credit?
Sales.
Rent revenue, right? Rent revenue. Rent revenue, 500. From unearned to earned revenue, right? So same thing, debit unearned revenue, 500, and credit rent revenue, $500. And this is what you study in Accounting Principle 1, a couple of semesters ago. Okay, and this is for accounting. This is for accounting, not for tax, but accounting. Okay, so this $1,000 unearned revenue. What kind of account is this? What kind?
Liability.
Liability, right? This is a liability. So in the first year, no liability was reported, right? Zero liability. Zero liability in the first year, 2001. But 500 rent revenue and 500 rent revenue. Okay? 500 and 500 reported on accounting income statement, right? And for tax, so this is for accounting. For income tax, okay, the tax revenue and tax expense are reported on tax return on the basis of cash collection and cash payment. So all 1,000 is reported on 2001 tax return because 1,000 was collected in 2001. Okay, and nothing for tax. So the difference between accounting and tax rent revenue is negative 1,000 in the first year, and 500 in the second year, and 500 in the third year. Right? Zero accounting rent revenue, 1,000 tax revenue in the first year. So difference is negative 1,000. 500 accounting rent revenue, zero tax rent revenue. Difference is 500. And same 500 in the third year. So these are temporary difference between accounting and tax rent revenue. Okay? In the long run, 1,000 accounting rent revenue and 1,000 tax rent revenue. In the long run, zero difference. Right? So this is another example for temporary difference. Okay? Difference between accounting and tax rent revenue is temporary. In the long run, zero difference. Okay? So in the first year, 2001, sales revenue and cost of goods sold, these two are same for accounting and tax. Okay? We assume so. Sales revenue and cost of goods sold are same for accounting and tax. The only thing different is rent. So 0 rent revenue for accounting. Okay, zero rent revenue for accounting, but 1,000 tax rent revenue in the first year. Because of this difference, accounting income and taxable income are different, right? The first year, accounting income is 300. First year, taxable income is 1,300. Difference is $1,000, right? Difference between taxable income and accounting income is 1,000 in the first year. And that 1,000 difference come from this temporary difference, okay? So in 2001, the first thing we have to figure out is income tax payable. Income tax payable from this, I just erase it. Income tax payable is always taxable income times tax rate, 40%. So 520 income tax payable. Okay? Income tax payable first. And then in 2001, the tax expense is greater than accounting expense, right? So we are looking at this situation. This one, tax revenue. Tax rent revenue in the first year is 1,000, but accounting rent revenue is 0, right? So TR is higher than AR. And because of this large tax revenue, this company has to pay large tax in 2001. And that means less tax will be paid later. Okay? So company has an economic benefit to pay less tax later. So DTA is recorded. DTA. DTA. And the amount of DTA is 1,000 temporary difference times 40% tax rate is 400. Okay? So in the first year, tax revenue is greater than accounting revenue. Right? Tax revenue is 1,000, but accounting revenue is 0. And because of large tax revenue, this company has large taxable income compared to accounting income. So more tax now, less tax later. Okay? More tax now, less tax later. So DTA is recorded. The amount is 1,000 temporary difference times 40% tax rate. And income tax expense is again plug number. Always plug number. So asset on debit, liability on credit. And this temporary difference will reverse in the second year. Okay? Reversal in the second and third year. So there must be decrease in DTA in second year and third year. Okay? Decrease in DTA in 2002 and 3. So do the same thing for 2002. Income tax payable always based on taxable income, 300 in the second year. And decrease in asset on credit. Second year, temporary difference is $500, right? Second and third year, temporary difference is 500. So 500 decrease in DTA times 40% is 200. And income tax expense is always float number. And again, at the end of the third year, okay, the balance of DTA should be 0, right? 0. what do you think about the chapter 18? Is it really hard, super hard, or what? Not much, right? Yeah. Just two things, income tax payable and DTL or DTA.
A lot of hoops to jump through.
Yeah. Okay, let's take the quiz. There's only one question.